Welcome back to America's Commercial Real Estate Show. I'm Michael Bull. Thanks for being with us. This segment is brought to you by Xceligent, building data everywhere, xceligent.com. My guest is Mark Grinis. He's Global Real Estate Investment Funds Leader with Ernst Young, and they've recently published their 2017 Global Market Outlook. We'll have a link to this report on our website. And Mark, in the last segment, you were talking about the Trump effect and interest rates and how that might impact the economy and commercial real estate. So what do you think? What do you think for interest rate increases in the next couple of years?
Right. Well, I guess let's start by the inauguration, where we immediately started seeing the stock market move. We started to see the 10-year move. So market participants had the expectation of some growth, and the 10-year started to move. It's since backed down. Obviously, we've seen some changes. So, what ultimately is going to be the outcome? Is a strong growth going to really drive interest rates? I think you got to step back and look at where we've been for the last 8 years. We have been through an incredible experiment of central bank policy. We started a little bit before the financial crisis of central bank balance sheets at $2 trillion. Today we're at 12. So you've had a central bank policy of quantitative easing, creating money and buying financial assets, and really being a gigantic player in the marketplace, driving down interest rates. And that's been going for some time. Obviously, the Fed has slowed down, but other EU and others are still spending $1 trillion a year buying financial assets, keeping interest rates stable. That's a huge dynamic that controls interest rates. And so the question is do we have any precedent to how does that unwind? How does that experiment end? Does it end gracefully and easily, or do we have some fits and starts along the way? Does the central banks just let all the assets on these balance sheets run out? I think the answer is it should be able to manage a stable recovery. But I think the reality is, as much as interest rates have been a tailwind, the fact of the matter is interest rates and cap rates are going to be a headwind going forward.
So what would you guess when you look into your crystal ball, you look into your outlook?
Our lawyers tell us not to look into our crystal ball.
Well, we have one here. We won't tell them it's here. Well, the Fed's kind of indicated what they think they may do. So what do you expect based on what they're saying?
Look, I think an expectation of 2019 of 125 basis points going up, that certainly is getting to more normalized levels.
You think it may take that long to get that high? Okay.
The way the market has really retraced, rates have really dropped back down. Messaging that maybe it might not be as strong as expectations were right, and at that I don't know if it's euphoric. It depends, I suppose, what your political leaning is, but at least the period of the response to the Trump election. So I think the rates have pulled back. I think really when you think about GDP, we are getting close to full employment. So, will all of these pro-growth policies start to drive growth, a lot more productivity, growing GDP, and consequently strengthen interest rates? I think it will.
Yeah. So you expect 125 basis points increase by 2019. So how might that impact commercial real estate values and cap rates moving forward?
They're not directly correlated, but obviously they follow a similar follow the same trend line. It's not an immediate response, but they will trend up. They will follow the triple B. Is most closely correlated. What does that mean? That means that headwinds from prices have got to navigate NOI growth, because clearly those two have an interplay. Where interest rates are today, they're pretty low. And so if cap rates move 125 basis points, it takes a fair amount of NOI growth to offset that capital change as opposed to for capitalization rates. I actually think that's some of what we're seeing right now. If you look at transaction activity in the first quarter, it slowed. I think people are looking and setting up realistic expectations of where cap rates might be at termination. And that is creating some challenges in the bid-ask of where people are coming together on willing buyer, willing seller. So I think there's short-term cooling, but ultimately a stronger economy is better for commercial real estate and better in the long run.
Yeah, well, that's a good point. And we are headquartered in Atlanta. We have 30 brokers doing different property types, and we're already seeing some indication of some slightly rising cap rates, especially on product type that is impacted maybe sooner than others, like single tenant net lease properties where the NOI is more stable anyway. So you don't have that offsetting it.
That's right.
We're already seeing increases there, and I think as we look at the second quarter results, I think we will see some increases. So what does that mean for foreign investment and deal volume in commercial real estate moving forward?
Yeah, I think on the initial data looks like it's cooling, and I think it has to be put in the right context. 15 and 16 were pretty robust, particularly 15 being a pretty high watermark for transaction volumes. So everything is relative to that. If you step back and say 09 to 15, that has been simply a one-way train and incredibly strong. 16 a little bit dropped off the peak. And I think you'll see a little bit of a drop-off again for 17. But still robust overall deal volume. So, on a same-store basis, clearly there is a pullback underway. On an aggregate absolute dollar, there's still incredible strength and a healthy deal volume in the marketplace.
What about foreign investment in the U.S.? What do you expect moving forward there?
The headline obviously is China. They invested $20 billion in commercial real estate in 2016. That is a significant allocation of capital and clearly a market mover. Each transaction, I don't think there was one or many, if any, that were less than $1 billion.
Yeah.
So these are big juggernaut transactions that are looking to invest. I think you have to look at where to invest overall. If you take Finland, they've allocated a little more than 13% of their investable assets in real estate. Japan, 5%. The biggest pension fund in Japan, $1 trillion pension fund, just said, we need to increase our allocations to real estate. We need to invest in alternatives. So you have players, global players, that are looking around the world to where to invest. Allocations are still underallocated in many of the major countries like Japan and others. I expect that transaction volume and that capital to continue to flow into U.S. real estate.
And the quick answer to this, do they feel like Trump is a good reason to maybe look at investing more in the U.S. or less? He is a real estate guy.
As one of my clients, and I spent almost 7 years in Japan and looked at all of the countries in Asia. And when you look around the world, investing in real estate needs a lot of elements: rule of law, ability to exit, some level of transparency, significant size to get enough capital to work. There are key elements of where around the globe, if you pick a place, that kind of falls into that institutional investor box. And the U.S. has been capturing 60% of all of those dollars, and there's a reason for that. Rule of law, investable assets, key institutional quality real estate, it shows up on everyone's list. I don't expect that changing anytime soon.
Yeah, well, and that's good news for the U.S. Hi, we're going to take a short break here. When we get back, we'll have more on the commercial real estate outlook from Mark. Stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show. Hey there, thanks for checking out the Commercial Real Estate Show. Don't miss a video of special interest to you. Be sure to subscribe below. And if you appreciate the videos, be sure and thank our sponsors. There's a link to more information about them in the description. For more videos, podcasts, and articles, check out CREshow.com.